Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We are thrilled to get you started in the 7 o'clock Wall Street time hour with David Rosenberg of Rosenberg Research, absolutely definitive at Merrill. Let me explain why David Rosenberg was definitive years ago. He would put out a report, Paul, and it wasn't page one. It was like the new, like Bild in Germany with half-dressed women. On page 3 is where you got the real Rosenberg, not half-dressed women. You got his inflation's dissection.
Okay.
He would have every single line item of inflation lined up. That became famous at Rosenberg, and he joins us this morning on the quality of our new inflation. David, what is the character of this inflation in 2025?
Well, it's a real dichotomy, Tom, and a bit of a head scratcher, especially from the numbers that we got in July from the CPI and the PPI, because, we're all expecting that the tariff impact is going to hit the goods sector. But was really puzzling in both reports was the fact that service sector inflation isn't going away. And I think that's a bit of a problem for the Fed. I still think that, the trend in inflation will be heading lower. I wrote a report talking about something very nebulous, otherwise known as the quantity theory of money, in my daily yesterday, going through money supply growth, which is starting to cool off, and money velocity, which is flattening, and in relation to where the real economy is, and then solving for inflation. And we're going to be getting towards the target or probably below, but not for another 6 to 12 months. So it's a trend, but it's not a present day reality, but it's out there.
As we had stimulus in 3, Olivia Blanchard calls it the Biden stimulus, the back stimulus of COVID. I mean, is it just simply, David, as you say, you delay a disinflationary call out 18 months, say? Is it because of the stimulus of Mr. Trump's new legislation just passed?
Well, you know what everybody calls stimulus from the big, beautiful bill really isn't stimulus from the status quo. The biggest chunk of that was just maintaining the tax cuts from 2017 in the personal sector. And then you could argue that the bells and whistles, mostly from the depreciation allowance benefit, insofar as that, improves the capital spending picture, that is supply side growth that you would hope would generate productivity, which is antithetical to an inflation view. So I don't really look at the fiscal side as being a source of inflation. Of course, the greater supply that we're seeing benchmarked against expectations is what's caused the back end of the yield curve to remain so elevated. But the inflation that we're seeing primarily is coming from the tariffs. For anybody that thinks that tariffs will not be at least near-term inflationary, seem to ignore the fact that it's the importer on record in the United States that actually pays the duty. Then the question is how it's going to get distributed through the supply chain.
Right.
But I said the head scratcher, and it's just, 1 month's worth of data, but I was really surprised in July to see how stubborn the service sector was, because that's a part of the economy that had been cooling off. But those inflation numbers across most of the services, not just shelter, were a big upside surprise last month. I'm just hoping that it's not going to be sustained.
David, economic growth remainder of this year going into next year, I think most folks are expecting it to continue to soften, but still be some reasonable growth. How do you think about GDP?
Well, everybody has, redefined what reasonable is, what Jay Powell describes as solid, when we're barely running the economy so far this year, barely over a 1% annual rate. I mean, when I started in the business in the mid-'80s, you got down to a one handle on real GDP growth, and people weren't talking about reasonable. People were talking about stall speed and then asking, when's the recession going to start? So the economy, I think, is sputtering. It's uneven. Without the proliferation of AI data centers and all the technology spending related to generative AI, the economy would actually be in recession right now. That's been really the only underpinning, the only impetus to growth so far this year. So I'm thinking that the economy is going, I don't see what the catalyst is going to be. Even with the big, beautiful bill, it's not going to be adding a whole lot to growth, a little bit. And I think that the tariff uncertainty is still going to be a big element that's going to provide an overhang on the economy going forward. And the Fed's going to be deliberately slow to cut interest rates. So that's going to have an impact negatively on the credit-sensitive sectors of the economy. And it's not as if the rest of the world is actually operating at a very high level of economic activity. That's going to come back and bite the export sector. So I think the economy is going to remain very weak through the balance of this year and the next year. The only question is for the Fed is demand weakening in relation to what's happening on the supply side? Because the supply side is also weakening alongside the demand side. From an inflation standpoint, it's how those two curves, demand and supply, in the broad economy, how they're interacting, that's going to determine what the inflation outlook is going to be.
David Rosenberg with us. We continue with Mr. Rosenberg. We welcome all of you across Canada and David's Toronto. Thank you for joining us and the way you listen to us on SiriusXM and other outlets as well. Apple CarPlay, Android Auto. Good morning on YouTube. It's building each and every day. Paul and I just sort of blown away by the whole Google YouTube experience. Subscribe to Bloomberg Podcasts is the quickest way to get us and get us often as well. What he said there about ages ago, Paul, where a 1%, 1.x% economy was stall speed. Why has that talk gone away?
I haven't heard that. Yeah,
to me, it's this divide between the haves and the have-nots.
Yeah, exactly.
But I think David's dead on about how the recession language has changed.
David, given that backdrop of slower growth, percolating inflation, what are we going to hear from Fed Chairman Jay Powell on Friday from Jackson Hole, do you think?
Well, it's a great question. If this was September the 10th, say a week before the FOMC meeting, given that there's 85% market-based odds priced in for a 25 basis point cut, he would probably acquiesce. But there's still a lot of time. And I don't think that Jay Powell in his mind thinks that we really have an 85% chance of seeing a rate cut. So this is really more of a trade. I think over time, the Fed will cut rates at the right time, probably cut them aggressively in the next year, but again, at the right time. I have a tough time believing that he's going to be talking dovishly, at least relative to what's priced in. I would expect to see on Friday morning those 85% market-based odds of a September rate cut. I think they'll be dialed back. And I say that because, everybody seems to believe that because the thesis of the Jackson Hole Symposium is about the labor market, everybody seems to think, well, we had a pukey July non-farm payroll number, downward revisions to the previous 2 months, so it's got to be dovish. But I think what's going to come out of it mostly is a sign that, yes, labor demand is on the decline, but guess what? And this is what I mentioned before, labor supply is also on the decline. And how those two wash out is going to depend on what the Fed's reaction function is going to be. So I think that there's going to be a lot of surprises. I think that he's not going to sound uber hawkish, but I think that benchmarked against what's priced in, I think there will be disappointment. And I think there's actually a good chance, despite all the political pressure, because you got a Fed chairman, he'll be gone after May. He is going to be determined to preserve his legacy. And I think he's going to block out the noise from the White House. So my sense is that, and this is from a bond bull, but I think over the near term, the outlook is clouded. I think that although you have some dissents, and remember that Volcker, back in the mid-'80s, would sometimes face a meeting with at least 3 dissents. So that could happen. But the chairman is usually in control, and I have a tough time believing that he's going to sound as dovish as what the markets have priced in right now.
David, are you surprised that the equity markets have rebounded the way that they have coming off some of those tariff concerns earlier in this year? And if so, what does that tell you?
It tells me that there is a ton of speculation in the marketplace, especially as it relates to the productivity and return on investment assumptions coming from the technology boom. So, we're reliving to some extent, not fully to some extent, what happened in the late 1990s. This usually happens after a major shift in the technology curve. The markets get way ahead of themselves. And I think that that's been a big part of it. Of course, you've also seen the market broaden out, even in this very weak economic environment. I mean, it's not a recession, but 1% plus growth. But you've seen the market broaden out. I think a lot of that has come most recently from this view that the Fed is going to, ride the cavalry and start cutting interest rates next month. I think that's where the folly might be. Right. But, I'm taking a look at this market, and look at where real rates are, roughly 200 basis points benchmarked against like a PE multiple forward of around 23. If this is not a bubble in the equity market, and I know that people view that as a very emotional word, if it's not a bubble, it's a giant sud. Okay, so we're just back into psychology of a bubble mentality as it pertains to the broad equity market.
David, thank you so much for a morning briefing here. Alicia Levine coming up. Mr. Rosenberg with Rosenberg Research. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Monica Guerra with us now, head of U.S. policy, Morgan Stanley. She walked in and she's got a sentence in her note, Paul. In English, I couldn't understand it. Let's go to French where I really can't understand it. Notre plus grande préoccupation à l'heure actuelle est liée à la capacité de reverse repo. Enough. Okay, let's go wicked short term. Your study, and this is percolating out there in the Ira Jersey world. Mm-hmm. We're doing T-bills for our new fiscal deficit. How does that fold over into what I call the short-term trust market, the repo market?
Now, what's been interesting about this is if you think about the repo market being drained as well as the Treasury General account is coming down, when they refill the Treasury General account, which they have to do post-OBVA, you're going to actually be pulling liquidity out of the financial system. So what does that mean? It means you get more volatility on the short end. And we've had a Fed that since Yellen has been doubling down, right, on short end issuance, right, on T-bills. You had Trump be initially critical of that. Bessent's now all in. And then we have sort of this move with this pro-crypto policy, right? So to try to, pull it all together here, where if you do have more stablecoin, or if you do have more digital assets that are linked, right, or anchored to the dollar, you have to have more T-bill issuance. So this is going to be, a continued trend in our view.
So there's an explosion of T-bills, 3 month T-bills?
3 months and under. Mm-hmm.
3 month and under. Paul, help me here. There's an explosion of T-bills, and you're saying money comes out of the system. I mean, in the old commercial paper days, that was not good.
Right.
Is this something people like me who don't understand this, is this something we should start thinking about? So
there's two things you have to think about. If we're going to let's keep it to a 2 month window right now. If you're thinking about September and a October potential government shutdown, right? And you have more T-bill issuance, pulling liquidity out, potential government shutdown, they can't issue, conditions stay tight, okay? Once they start spending that OBBBA money, then the liquidity issues start to loosen up. I don't think the 25 basis point, if there's a 25 basis point cut in September, is going to really offset that tightness in the next 2 months. So I do think we should be ready for a more volatile market in this 2 month window.
I say, Paul, this is why Bessent wants us to go through 4, 5, 6 rate cuts.
I
mean, that's the real reason.
Do you think a government shutdown is likely, possible? How are you guys thinking about that? How are you handicapping that?
Yeah, I mean, I think it's likely. And when we're thinking about the, over under on it, I would say, this is probably the most tenuous point for the Democratic Party in recent history, right? As far as having a message, a vision, a direction from a cohesive lens. One thing that did not work out for them was when they kept the government open under Schumer earlier this year, right? When they voted for that continuing resolution. And so it could be potentially politically expedient for them, right, to hold a hard line.
But I don't even know who's the voice of or actually running the Democratic Party in this country right now. No idea. Haven't heard from them since January 1.
I think that's the feeling from most folks. And so when you see someone
void. If I were like a politician, I'd be jumping into that void, wouldn't I?
Well, you see someone like Gavin Newsom, taking some punches, and people seem on their end, right? If we're thinking about the spectrum of politics, on that end of the spectrum, are responding positively. So I see that as a green light for playing hardball in a way that Democrats don't typically do around budget. So this could be one of those outlier moments.
If we do get a government shutdown in October, is it a couple of days? Is it something longer? And how should we think about that?
I think that the longest we've ever gone is about 30 days, about a month. 8 days is the average.
8 days.
8 days is the average shutdown. 30 days, once you get over that past 30 days, then you start compromising government workers' rent payments, right? Ability to live in a paycheck to paycheck type scenario. And Democrats do tend to try to avoid that. So you could see them come back and reopen the government in that window.
Link the stock market into your world of U.S. policy, or are they delinked?
I would say right now they are delinked. I think there's this look through on tariff policy. That's been the main driver, right? But for us, we want to, dig a little bit deeper and see, which sectors in industry could be impacted beyond just tariffs. And that's where government shutdowns become important. When you're thinking about the longer term, that's your heavy government contract industries. Defense and healthcare are the top sectors.
We just took a poll of 100 people out on YouTube, and 102 of them did not understand our repo discussion.
Yeah.
It's amazing how that is. What's it like lecturing people, interns at Morgan Stanley on the repo market? Eyes glaze over?
I try not to, so next time I won't.
Okay, this has been great. Monica Guerra, thank you for confusing me evermore. She is with Morgan Stanley. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We're going to talk equities with Alicia Levine, head of Investment Strategy Equities, BNY. But unfortunately, that's not why she was booked. She and I are sharing the youngest cherub off to college. Paul, do you remember when the youngest cherub went off?
He about to start his junior year.
The difference here is Alicia Levine's offspring is taking like real manly courses.
Yeah,
right?
Mechanical engineering.
Like
I'm
high above Cayuga's waters.
I'm frightened.
Chemistry, physics,
calculus, and thank God a freshman writing class.
Afterthought is somewhere north of the River Seine, taking Introduction to Catherine Deneuve and The Path to Brigitte Bardot.
Okay,
there's a difference here.
That's more fun.
That's more fun.
fun.
We're surviving, aren't we?
It's hard. It's
the
harder.
last one is brutal.
Brutal.
It's just like terrible. Plus, we're broke because we've paid umpteen $1 million.
We'll be working till we're 90.
We're never gonna retire. With that said, if I'm in a 401k, I'm hearing lots of go to cash. I don't buy it.
You can't go to cash. We've had this conversation now for several years. The cash trade is very specific when the Fed is hiking rates and the market is experiencing a true sell-off. We think what's happening now is your typical air pocket in the summer. We had this massive run up. I mean, at one point, NASDAQ was up 56%. From the April 8th lows, the S&P up 34%. Those are historic runs. And so you're hitting the typical air pocket. What will Jay Powell deliver on Friday? Will he be a hawkish dove? It's not going to be 50. I think this is just noise. Earnings numbers are going up. Corporate America has been much more resilient than feared, and some numbers are going higher for 2025 and 2026. Ultimately, like other times, this will be a buying opportunity.
What did you make of the earnings season that we just completed? Kind of came in better than expected, although maybe the bar was lowered for the street, but the numbers came in pretty solid.
The numbers came in very solid, about 12%, when about 4% was expected. That's part of the reason you had that torrid run in the market, because the earnings were just solid and coming in. As a result of that, the first half of the year came in much better than expected, lowered expectations for sure, but lowered to a point where it matched why the market dropped so much, in March and April. And so you're having numbers also moving higher for the rest of the year. I think what's not talked about actually what's going on in the financial sector. I mean, numbers are going higher there. That's not reflected in NASDAQ. And that's part of what the run has been about, has been financials as well. We spend a lot of time talking about tech, bright, shiny object. Everybody owns them, so therefore vulnerable. But financials have been terrific also, as well as industrials.
You mentioned, I see in just kind of your sectors, utilities and industrials. Is that kind of the, bringing stuff back to America, manufacturing and just kind of all that stuff?
It's the data center build out. The data center build out. Of course, if the Fed is cutting, utilities will do well also simply on the interest rate play. But we're really looking at a structural change in the U.S. economy where capital is flowing. I think what hasn't been talked about is the one big, beautiful bill. We talk about tariffs night and day, but we haven't talked about the incentives buried in the one big, beautiful bill for data center build out for capex and investment in structures. In the most recent earnings season, 275 companies mentioned that the tax provisions within the bill are going to be positive for their earnings and for their businesses. And that has really been under the radar in a sort of a shocking way. It's part of the reason numbers are moving higher.
Alicia Levine with this Bank of New York, BNY, thrilled that she could be with us today. The problem I have with the gloom over the build-out, obviously it's an unknown. We really don't know about it, is essentially with the profit generation of these companies, a portion, if not all, of their capex. It's a rounding error, but it's not that big a deal. We don't understand the scale of their profit.
So there is so much cash flow and profit in these companies. The scale of the capex this year, it's about $370 billion. Very interestingly, that's also the tax benefit from the one big beautiful bill in 2026, about $400 billion. It also equates to the tariff hit, which is a tax of $370 billion. So they're offsetting each other, right? The tariff hit, which is a tax, and the spending that these companies are doing. So there was a reduction in free cash flow margin for the Magnificent Seven because of that. But ultimately, these companies can handle it, and their margins remain high. So in a sense, you're getting paid to wait to see if this works.
I mean, Paul, this is not 1999. You and I keep saying that.
Yeah, having been there in 1999, pumping out those companies back in the day. Alicia, what do you think the Fed should do for the remainder of this year going into next?
So I think they will cut.
Okay.
I think they'll cut 25 basis points in September because ultimately what's happening in the labor market will outweigh what's happening on the inflation front. The bump in inflation, for the most part, we've heard from the Fed is going to be, they don't say it's transitory, but they're saying it's transitory. One-time hit is the same as transitory. A slowdown in the economy is not something that the Fed's going to be able to stomach, and the labor market is now at a lower equilibrium rate. Harder to play with that, right? If your equilibrium rate on hiring is 100 to 120,000 jobs, and now you're down to something like 50 to 70,000, you just don't have as much margin for error. So they're going to cut. And they've taken hikes off the table. So the Fed is cutting. The market's near all-time highs. The economy is getting this bolus of investment into the AI infrastructure and in industrials.
Right.
So we think you have a cyclical upswing. The PMIs have not caught up yet. We think they will.
I got to get two things in here. The first one is the basic idea of investment for our viewers and our listeners is simple. I'm in it for the long haul. How do you look over the horizon to 26 or 27 right now?
Look, we always have a 12 to 18 month horizon. And even the scare of, let's call it early April, is something that our clients in BNY Wealth are well used to. If you think about the last 10 years, we've had 20% drawdowns or more. And every single one of those times have been an epic buying opportunity. So the long haul is you add when you can, when you have liquidity or cash, and you don't sell because you always sell at the low, always.
For on YouTube, I've got my cell phone in my hand. Alicia, let's cut to the chase. Are you following your children on your iPhone at school?
I will never answer that question.
When I went to school,
I plead the fifth.
when I went to school, my parents didn't know I was at the Sink or at Tulagi's in Boulder.
Right.
I mean, they didn't know what we were doing. I just sent a text, no TV. Do you allow a TV in the dorm room?
It wasn't my choice. We have roommates.
You have a TV in the dorm room at Cornell.
It's not a we thing. It's an I thing. I don't. My child doesn't.
Paul, it's just different.
Gotta let him go. I
went with a slide rule.
Yep.
We did not major in mechanical engineering.
Yeah. We'll see. Alicia, my deepest sympathies. I hope the marriage survives, and also good day to your afterthought in Cornell. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
You're right, too, at the newspapers with Lisa Mateo. She's at 3 a.m., locked and loaded. Lisa, what do you have?
Yeah, I got to catch up for not doing it the past few days. Okay, so we've been talking about the struggles of the luxury sector, right? Well, Louis Vuitton is betting on cosmetics. They're hoping that it's going to help out at select stores worldwide this month. You can buy its La Beauté, Beaute, is that right? Louis Vuitton line, close enough. 8 eyeshadow palettes, 10 lip balms, 55 lipsticks. Are you ready for the prices?
Sure.
Okay, here we go. The scented lipstick, $160. Okay, that's double that of a similar offering from Hermes, 3 times the price of Chanel. The eye palette,
what do you pay for
$250. I go to CVS and I pay $10-15 maybe. I don't know, $15.
So this is a premium product.
It is. And if you want like the high end, you can spend $3,000 and get a monogrammed canvas mini trunk to keep all your lipsticks
Is
in there.
it working right now? Is your sense, isn't quiet luxury a thing?
Yeah, right. It's supposed to be.
$160 lipstick is not quiet luxury.
No, it's definitely not. But yes, if you have the money to spare, then that's, I guess, where you...
I highly recommend.
Exactly. But I mean, they've been trying different things, the cafes, the chocolates. So this is just another kind of sector to boost some interest in luxury. Okay, this news out. This is from the Washington Post. A month before it was set to be banned, the White House has launched an account on TikTok. Yes, the ban was, of course, due to national security concerns, set to go in effect September 17th unless it's sold to a U.S. buyer. But yesterday, the White House became its latest user. Take a listen.
Every day, I wake up determined to deliver a better life for the people all across this nation. I am your voice.
And that was the first post. White House TikTok account launched the video montage, images of him, UFC head Dana White, law enforcement officers, American workers. So yes, that launched just as a ban is getting set to go into effect.
Sort of ominous music.
Yes. Very
ominous.
Very ominous. Very ominous.
What do you got next?
This is for, the moms and dads getting ready to ship the kids off to college. The dorm room. It's all about the dorm room, right?
You're killing me.
Chipotle knows it, and they know college kids because college kids love Chipotle, okay?
Really?
So they're targeting them. They have a promo, like what do you call it? Collab with Urban Outfitters, a product line that has a nearly $100 blanket. You can get a lamp, a Chipotle-themed water bottle, pillow, beanbag chairs that are just under $300 each. all for your kids to decorate their dorm room with Chipotle. There's even a doormat that says, leave my Chipotle here.
Remember when we had beanbag chairs? Everybody bought a beanbag chair and no one sat in it.
Yep.
It just sat there like a, mushroom.
It looks good. It looks good.
It was cool.
It does. They even have a new loyalty program for these college students. It's called Chipotle U. So you can earn points. So you can get free food, or you can even get enough points to waive the guacamole fee, which is key. You have to, because there's an extra fee. If you want the guac, there's a fee. So you get the points, and then you get the free guac.
Do you know what the highlight is? Across from Afterthoughts dorm place where she's in Europe,
yes,
there's a bubble tea place 4 stores away. And Mrs. Keene said that's all that matters, is bubble tea is close.
Okay.
I know. It's all about the bubble tea and the Chipotle.
I've never had a bubble tea.
You're
Thank you for
missing
that.
out.
Lisa Mateo and the newspapers here.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.